All right, let's talk about the hidden financial powerhouse that might just be the roof over your head. We all know a home is a place to live, right? But it's also one of the most powerful financial tools you can possibly own. So today we're going to look past the curb appeal and the new kitchen countertops and really get into what that means for your wallet.
And that's really the big question, isn't it? Is your house just an expense? Or is it an asset that's actively making you richer? We're going to break down exactly how you can shift your mindset and turn that property into a true wealth-building machine.
Okay, so let's start with the big picture. When we talk about a home's financial power, it really all boils down to three core concepts, three main ways it helps you build wealth over the long haul. And here they are, the big three. First, building equity. That's the part you actually own. Second, getting those annual tax deductions that save you money every single year. And third, the big one, enjoying a potentially huge tax-free profit when you sell. So let's dive into that first pillar. First up, equity. You hear this word thrown around all the time in real estate, and for good reason. It is the fundamental concept that separates renting from owning, and it is where your financial journey as a homeowner really begins. So what is it exactly? Well, the textbook definition is right here, but think of it this way. You take what your house is worth on the open market today, you subtract what you still owe the bank on your mortgage, and that leftover amount, that's your equity. That's your slice of the pie. Let's make this super simple. Say your home could sell for $400,000 tomorrow, and let's say you still owe $300,000 on your loan. Well, that means you have $100,000 in equity. That is your actual stake in the asset. So, the magic question, how do you get more of it? Well, your equity grows in two really cool ways at the same time. First, every single mortgage payment you make chips away at your loan principal. It's like a forced savings account. And second, while you're doing that, the market value of your home can go up. So you're building wealth from two different directions. It's fantastic. Okay, moving on to pillar number 2. Your home isn't just a long-term investment. It can actually put money back in your pocket every single year, right around tax time. And this is where things get really interesting, because these savings can be pretty substantial. The two heavy hitters for homeowners are deductions for your mortgage interest and your property taxes. So let's get into how these actually work. Now, the rules for deducting mortgage interest are a little tricky because they depend on when you got your loan. If you got your mortgage before December 15th, 2017, you can deduct the interest on up to $1 million of mortgage debt. But for any loans taken out after that date, the limit is a little lower, at $750,000. Either way, this is a huge benefit, especially in the early years of a loan when most of your payment is interest. Okay, get ready for the next magic number you need to know. $10,000. This number represents a firm cap on another major deduction that homeowners can take. So what's this 10 grand all about? Well, it's the maximum you can deduct for what's known as state and local taxes, or SALT for short. This includes your property taxes, plus either your state income taxes or sales taxes, all bundled together. But the total you can claim from that bundle is capped at $10,000 a year. We've covered growing your stake in the home and saving money each year. But now for the grand finale, the massive financial windfall you can get when you finally decide to sell. Take a look at this number, $500,000. And no, this isn't a loan you have to pay back or some complicated accounting trick. This represents potential pure tax-free profit. Think about it. Normally, if you sell an asset like a stock and make a profit, you owe capital gains tax to Uncle Sam. But your primary home, it gets very special treatment. The government says a married couple can make up to $500,000 in profit from the sale and not pay a dime of capital gains tax on it. If you're a single filer, that number is still a massive $250,000. This is, without a doubt, one of the biggest wealth-building perks in the entire tax code.
So what's the catch? Well, it's not really a catch, just a rule you have to follow. It's called the 2 out of 5 year rule. It's simple. In the 5 years leading up to the sale, you must have owned the home for at least 2 of those years, and you must have lived in it as your primary residence for at least 2 years. And here's a key detail. Those 2 years don't even have to be back to back.
But hey, before we wrap things up, there's one more awesome perk I want to talk about, and this one is specifically for all you first-time home buyers out there. If you're a first-timer, you can actually pull up to $10,000 from a traditional IRA to use for your down payment, and you get to skip the usual 10% early withdrawal penalty. Now, you'll still have to pay regular income tax on that money, but avoiding that big penalty can be a serious game changer when you're trying to scrape together a down payment. So, we've covered a lot of ground. Equity, taxes, sales. What's the most important takeaway from all of this? Well, it's knowing that you don't have to figure it out all on your own. So there you have it, the 3 core financial tools that come with owning a home: building your equity, taking your yearly deductions, and cashing in on those sale exclusions. When they work together, they can turn your home into an incredible financial engine. But this brings us to probably the single most important piece of advice we can give you. Tax laws are complicated and your personal situation is unique. Our source material says it perfectly. Real estate pros should always tell their clients to talk to a tax professional. Don't try to guess on this stuff. So you've got the toolkit now. You understand the financial machinery humming away inside your home. The real question isn't if your home can build wealth for you, but rather, what's the first move you're going to make to ensure that it does?